Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting next to Geoff Gannon. Geoff, how goes it?
It is going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. If this is the first time you are tuning in, be sure to check out all of our content. Go to focuscompounding.com to sign up for investment research write-ups by Geoff. And go to quickfs.net and sign up to get access to 20-year financials. Geoff and I use it every single day. It's a great platform. It's quick. That's why they call it QuickFS. And tell them that you came from Focused Compounding if you do sign up. So in today's podcast, we are going to finish our Q&A that we last did a call for questions June 22nd. I said in the last Q&A that we'll do, we got a bunch of questions that we'll do a part 2 to that to answer as many questions as we can. Every now and then, if you're listening to us right now, you don't know, I have a Twitter at Focused Compound, and every now and then I will do a call for questions because we really want to talk about what is on our listeners' minds. There you go. There's a tip for creating content. Create content for your listeners and viewers as opposed to yourself. So today we are going to learn about what is on our listeners' minds and answer as many questions as we can. And the first question, somebody wants to ask latest books that you've read.
I have read...
Get out my Kindle really quick.
Okay. I've read some books about banks recently, which are specific bank things, and they're in print, not Kindle. Mm-hmm. So I bought them used and stuff, so I don't know about recommending them. They're not expensive, but they're hard to find sometimes.
Used copies?
Yeah. Just because they only exist in print. They haven't like republished. Yeah. And then I'm trying to... you know what? I've read... The most recent one that I read is... I want to get the author name right. The Berkshire Hathaway book that just... is it Adam Mead is the author?
Is that the one where somebody said it's like the Snowball, but without the sex?
Is that it?
That was a review I heard about this book. I'm pretty sure it's that one.
Very similar to capital allocation.
Okay, so was it good? Was it about his bigger investments or what? Like
every year.
Time? Okay,
every year. Listed everyone. Can we get the? Can you go to Amazon so I can get the actual one, because I don't want it.
What's the title of the book?
Berkshire Hathaway. Let's see if I have the author right. So is it at Berkshire Hathaway, and then there we go.
Okay, yeah, it was this one. The Complete Financial History of Berkshire Hathaway.
Okay.
Adam Mead.
Yes. So so I read that. And that's the most recent one that
on your Kindle?
Read. I have it in print as well. No, I have it only in print. No, I have it in both print and Kindle. Yeah. Was
it a long book?
Yes, it is long.
Oh wow, 882 pages.
Yeah, it has pretty long footnotes. They do footnotes. They do like end notes. So like notes at the end of every chapter instead of just notes at the end of the book or footnotes that you read at the bottom. I don't know that people do footnotes anymore. I guess you'd have to click them on Kindle. Yeah. So if you want a year-by-year rundown of all of those things, if you were only going to read one, I would suggest reading Capital Allocation, which we talked about before. We had the author on and all of that. I would certainly suggest that. I think that that's the easier one to read, the most interesting part of Berkshire Hathaway's history. This one goes all the way, though, to today. Mm-hmm. So you're going to, when we talk about things like Genry or something, you're going to have all that, which you're not going to have. So I think this has a ton of information about the more recent years. And certainly if you don't read the annual letters or even actual annual reports too, and are really interested in it, then I'd say like the more recent part is kind of the most different from other books. Most of the material covered, especially because Capital Allocation does such a good job of covering it. For the earlier years, I don't think is as important. But if you want to know a lot about Berkshire in like the 21st century or something, this does go into more depth than any other book that I'm aware of. Yeah.
And they don't really talk about his personal life too much in this?
No, this is very financially oriented, very much what was put in the annual reports and the letters, but like stuff that actually appeared in the annual reports, definitely, yeah.
Got it. I've been reading 69% through the Caesar's Palace Coup.
Okay.
Talking about that. I recently read So You Want to Start a Hedge Fund, kind of more like operational stuff by Ted Seides.
Yes. Oh, okay. Yeah.
To learn a little bit more about just different things that other managers are doing, like on the business side, operation side.
Are you thinking of starting a hedge fund?
Yeah. The Secret Life of Groceries. I sent that to you. Mm-hmm. I did download Bailout. haven't even started that.
So I don't know if I remember which one that is. Who's on the cover of that one?
This one is no one. It's just I think it says bailout, an insider's account of bank failures and rescues.
Oh, I like that one.
Yeah, I think you recommended that.
But it's like 4 or 5 different ones that it's what's it from the 60s through the 80s.
Yeah, I haven't read that yet. And then I finished Richer, Wiser, Happier.
Okay.
But apparently I got to read this Berkshire Hathaway book, this new one. I remember when they were talking about it on Twitter. I forgot that it actually came out.
It's not narrative at all. So you can read each chapter completely individually that way.
Oh, okay.
It really doesn't work that way. Yeah.
So it's like a dictionary, an encyclopedia. Like, I want to learn about this time.
If you think it's closest to capital allocation, but I think in some ways it's close to like a permanent value that way. If you think of a version of capital allocation, so financially oriented, but more like of permanent value, the way it's laid out in terms of how detailed
books.
It is, and
watching a permanent value.
Yeah. So like each chapter is like a year that way, and it's only if you really want to get in really detailed financial information and stuff, but about all the companies and things. It's much more. It really is about Berkshire. It's not about Buffett.
Oh wow. Okay. Yeah, I'm gonna buy that. Let's see. What are reasonable price to sales, price to earnings, and EV to EBITDA multiples for a company like PLTR? Goes against your deep value thesis, but just curious, what are fair multiples in your eyes for the industry? Thanks.
Yeah.
We could pull it up. PLTR.
Sure.
Whoops. That's Plantier Technologies. Yeah.
So
you want to take a step?
You can see, as we can see here, the issue, right?
Mm-hmm.
It's nearly impossible to figure out what it should be for a few reasons. One, you have very rapid growth, but you have very rapid growth with very high returns on capital because of the margins that you see there, right? So you can see that what you're dealing with is, as you imagine, like we've talked about it before, of any sort of like almost virally growing software type things or something like that is nearly impossible to value except using the total addressable market approach. And that's tough because you have to assign a probability. Well, they have the total addressable market. But if something should have a price to sales of 30 or something, it would be something like this. And look, there's much worse companies that trade for 10 times sales. Would I rather buy this than something at 10 times sales? There's lots of companies I see that are 10 times sales now that are in similar industry. Their industries have those economics, but the company's own economics don't yet reflect that. So it has a lot of the features that you'd expect in terms of the profitability that we can see. You can see with the gross profits and all of that. I don't have a really good answer to that. And I'm not sure that it's that. I mean, it's something that you have to decide yourself that way. But, we talked about Celsius and things like that. I mean, 30 times or something is a lot more than 10 times.
Sales, too.
Sales, yeah. But you really have to look at a few years out and stuff. So is it like going to grow fast enough? But the economics are good enough that yes, it can have a very, very high multiple and be right if the growth is there, but it has to be very, very high growth. I'm not sure if with the growth, and I can't evaluate that because it would need both here. It would need very, very fast growth for the next few years.
Same individual asks, valuations are frothy currently, etc. But would you guys consider looking at emerging markets, India in particular?
I think India would be hard for us to invest in.
Yeah, we can't invest in India.
Yeah. So,
but what about other emerging markets?
I don't know. I think emerging markets are hard for me that way. I've talked to some people in some of them. The kinds of investing that we do, I think would be tough to evaluate the people involved in all of that. We do look at different countries and try things from time to time to learn about that. I've talked about that with, last time I got a bunch of emails when I had said that I don't have a lot of connections to people in a lot of the world with like-minded value investors, and it was nice. I got a dozen emails eventually, so I responded to some of those people. But yeah, it's just really hard with the kind of approach that we take. If I was a quantitative value investor purely, more of a basket approach, then I would invest in emerging markets. They seem the cheapest to me. Emerging market value does look the cheapest of any stocks around.
Would you ever invest in Mexico?
I don't know. I mean, Mexico is very much emerging market. I mean, it's North America, but in terms of the political atmosphere and things like that, it's a very much an emerging market. So it'd be similar to a bunch of other countries that way. I've looked at some things in Mexico because people bring them up and stuff. I guess what have I looked at there? Stock exchange, airports. What else have I looked at? I had looked at indirectly at a railroad, some things like that.
I sent it to you. So we've actually kind of off topic, but we've talked about Sydney Airport a lot.
Yes.
And they're getting acquired.
Yes.
Saw that.
And it's interesting. Yeah. Even with COVID and stuff. And that's not, it won't be an all time high, right?
No.
So they were at a price pre-COVID that was higher, right? But yeah, airport stocks have kind of held up better than you might expect.
Yeah, they've done quite well.
Yeah. Yeah. I mean, they're not necessarily at much different prices than they were before COVID happened in some cases, like that one, which is, hard to believe, right?
Do you like mobile home manufacturers? Is Clayton Homes a good business? And someone says, isn't Clayton owned by Berkshire? Yes, it is.
Clayton is owned by Berkshire. I mean, it's a good business with Berkshire's backing in terms of financial.
The capital.
Yeah, because, manufactured homes, are going to, unlike site-built homes, are going to be sold in many cases with the ability to do financing along with it from the company. So it's like asking, do I like, the car marts used cars, or do I like selling 9-year-old used cars or whatever? I mean, I like it if you can sell it along with a 15% loan. So I think that, it was a terrible industry and that consolidated down by a huge amount. I think there's a pretty strong bias against manufactured homes. I think that, they can potentially make a lot of sense, obviously. And I think that there's always going to be some regulatory issues with it because people are going to write negative articles and stuff about that, I think always, just like what I was saying with the used car stuff, because sometimes you have marginal buyers on the low end of what they do. Clayton Homes, by the way, I think Clayton Homes makes the top of the line model might be a $200,000 home without any extra costs beyond that. But the bottom is pretty low.
What are books or topics that have helped you with investing that have nothing to do with business or accounting? It'd probably be like more mental model based.
Yeah, I guess so.
Psychology, mindset, stuff like that.
Deep work. Yeah, sure. Deep work.
Deep work. There you go.
Yeah, I like that. I said that was
like
a great
productivity
concept.
stuff, I would say.
Yeah, I thought deep work. Yeah, that was really strong for that. Oh, I did mention. What is the name of it? It's available online now. Probably, maybe illegally or legally, I don't know. But it came out of copyright and stuff. What is it? Oh shoot! It's called A Method for Thinking Creatively or something like that. A technique for thinking. Technique
for creating. For what? For thinking
creatively. What is it?
Let's see what comes up.
Okay.
Oops.
What's it called? A technique. Anyway, written by an ad agency guy from a long time ago. And they might be selling it on like Amazon. Someone might have done a Kindle version or something, scanned it in or whatever. But I'm sure that it can be found online, without paying for it too. But I forget if it's like 40 pages or less. But I happen to think that its description of, and it was, a particular advertising thing, but its description of thinking creatively, of having a good, useful thought about something and is investing, was the closest to a description of how I have had good ideas as anything I've ever read.
Really?
Yeah.
So can you give an example?
Well, it does a kind of, you could find other books about creative thinking in terms of research that people have done, but generally it takes a period of studying something. So you read everything that you can get on it and everything. And so they, take an ad campaign, you get everything about it and find out, the gas mileage of the car and how it was put together and all these things and what the history of it is and any of that stuff that you might possibly use in an ad, anything that you could think of. Mm-hmm. And then you take that all together and you learn about all that stuff. And then there's a period of incubation where you're not actively thinking about the about what you're trying to do. You might generate a lot of ideas about writing things down that you might think that you're going to do. And then you have, whether it's working on another project, often it is, that gets you completely off thinking about that, and then subconsciously you work on it. Or if you're actively thinking about it, and it may be walks, showers, whatever, things that in some way allow you to still subconsciously think about it. But usually it's switching to another project. Yeah. And anyway, it's the closest I've ever come to seeing someone actually describe that. And I think it's a very, very important part of investing. In many ways, it's like the most important is having a good idea. That's just the only thing you need to do. But often when you first read about an idea or something, you don't recognize it as a good idea. And it's the question of how do you shift your thinking about it and see, that it is something that you want to buy that way.
How do you think you do that?
The way that I talked about it. Yeah. If I could remember what the name of the pamphlet thing is, then if people want to know what my creative thinking process is, it's like exactly what that book describes.
Interesting.
Yeah.
I would say Great Courses has been interesting as well. Just learning about a bunch of different things.
What's its name now?
Wondrium?
Yeah.
Something like that. Yeah.
We'll see what direction it's going to go into. But yeah.
But just learning history. So different like economic history, different countries, about different political systems. I mean, just studying history, studying the rest of the world.
Yeah.
Becoming more worldly, I guess you could say, just by kind of allowing my interests to take me down whatever path I think could be interesting. And it literally could be watching a course on logic or watching a course on game theory, which I guess, you could tie that into business, but just learning about a bunch of different things, learning about different economic systems, learning about the Great Depression, the Industrial Revolution.
Yeah, Industrial Revolution, that's a good one, yeah.
Let's see. Over time, if an insurer's float is expected to be costless and growing, could it be considered quasi-equity?
Yes.
Is this better than pure equity since float equity doesn't dilute shareholders? Thanks.
Yes. Well, that's true. I don't know if you get people to agree with you on that because of accounting things and stuff. People will dispute that. But yes, that's true. And by extension, by the way, I should point out, to some extent, that's true of unrealized tax gain. Because, I mean, in that case, eventually it will be sold at some point, so it'll be worth closer to zero, but it's using up no equity to do it and all that. And people factor it out as if it's being something that you'd sell today, but it also will grow all the time, over time and all that. And certainly I think that's how Buffett thinks about it, what you just said there, in terms of the float, that it's better than equity. Yeah, it is.
Let's see. As much as we love Fintwit, do you think a lot of Fintwit is pump and dump? What makes all these fund managers on this platform different from Wall Street Bets?
I don't know.
You on Fintwit?
I'm not on Fintwit, and I don't know enough about Wall Street Bets.
Oops. Yeah, I don't really have an opinion on that. We don't talk about it.
I mean, we don't talk about our stocks however you use
anymore.
Yeah. It's however you use anything that way. And to be honest, I do like reading about things that people own themselves. I definitely like that a lot.
I would say Fintwit, in my opinion, it's become a lot less about ideas over the past few years is what I've noticed, to just a lot more just about everything else. And that could be the product of people that I'm following and stuff like that. But I do think the consensus of people that come to Fintwit to use it for like an idea generation tool, I think they would also agree that it's changed, I would say. Yeah,
that might be true, yeah.
Next question. Would love to hear Geoff's thoughts for working savers in terms of 401k after match versus Roth IRA versus taxable account.
I don't have any thoughts on that.
Talk to your financial advisor, I would say. A financial advisor. In a world dominated by intangibles and low growth, why would one only look at tangible assets in a return metric when so many companies achieve growth solely via M&A?
Oh, that's a great question. I would not. I mean, when I say return on tangible assets and things like that, same with gross profitability, I'll mention that sometimes. That's just a constraint of the minimum of what they can, of what they can make. They have to be making a good return on their net tangible assets. On top of that, you're right. If they're going to be doing M&A, they also have to have good returns on their M&A. But you really can't. Good M&A isn't really going to fix the basic problem that it's a bad business in terms of return on net tangible assets. But yes, and I get tons of questions. It's actually one of the most common questions I get of all, of like, how do I evaluate this company? It grows mostly on M&A, and they're making investments on your behalf. And so are they good investments? If you were making them as stock investments and things, would you judge this as good? The hurdle rates that they're clearing and all of that sort of thing. And it has to work both ways. I do warn people a lot about that, where they say this company has a 30% return on equity. It does. The core business, is doing that, but then it's going out and buying things, and because of the price that it's paying, if it's paying 6 times book for things that that have a 30% return on equity, you're not getting a 30% return on your M&A. You're getting an unacceptably low return on your M&A and a really great return on the continuing business. And so in the long run, that's not always great. We've talked about companies that have done that and how you have to take that into account. I think I talked about Middleby. We talked about TransDigm, things like that. They're, they in many cases own businesses that I think are good businesses, but I don't think that their M&A returns on their M&A necessarily on leverage match that kind of good business. And sometimes people are counting both of those things. They're saying it like this is a fast growing business. It's fast growing because of the M&A, and the M&A has much lower returns than the organic business.
How can you identify persistent revenue growth beforehand? I'd say the nature of the business, what they're doing.
Yeah, it's a lot of scuttlebutt. It's, and logic, and, what's reasonable, what isn't, but a lot of scuttlebutt of asking how did they get this kind of revenue growth?
Understand the sales cycle.
Yeah. Is it, are you selling more of a product? Are you selling more of a product and stuff without much of a marketing push behind it? That's really good if that's happening. Underinvestment in marketing, underinvestment in sales and stuff, and yet you're selling more of the product every year. I like to see that, the product selling itself. That's one of the strongest ones. Other one is some hints that your prices are too low. That you don't raise your prices each year and probably should raise them a little bit. There are ways to figure that out, either by talking to people in the industry or just looking at things that way. But usually it's a lot of organic stuff, a lot of stuff that just seems to be growing without much effort, without much attention by management, without actual investment in assets, a lot of investment in advertising, marketing, a lot of changing things, and yet you're driving sales growth, kind of effortless sales growth. The kind of things we look at much lower growth and stuff in them, but it is kind of the same idea of like something going viral. It's the product is selling itself somehow. What's harder to tell is when there's a big push behind something, and is it mostly being sold because of that, because of a big marketing push into it and all of that, and especially like consistent growth in something that doesn't seem to have much sales effort behind it in an industry in which that means they're gaining market share. So industry isn't growing that much, but this particular product sells more units every single year, and they don't cut their prices ever and stuff. That's a really good sign.
That's a good sign. Do you adjust your investing strategy based on market conditions, or is it buy and hold no matter what?
It's basically buy and hold no matter what if you're comparing it to market conditions. But if you mean selling something you own to buy something that's even better, that's more of what I'm comparing it to. So I would not sell something just because I think it's gone up and it's going to go down. But I would definitely sell something to buy something that's a lot cheaper and just as good or something like that. So, I'm not going to just be holding on to something that's at 40 times earnings because something just as good's at 10 because I do buy and hold. But not because of like macro market conditions or something like that. But always comparing to like, do I have something better to buy that I want to buy a lot of? So like funding something new to buy. Yes.
All right, let's do a couple more.
Okay.
Are you always fully invested, or what do you do with cash while waiting to deploy? Hold cash, S&P 500, T-bills, strips, or some other negatively correlated instrument, ? How much percentage cash is too much where it becomes a drag on long-term performance?
You can do the math on how much it becomes a drag on performance. If you think you're going to have a 10% return or something, you just apply that to the amount that you don't have invested. So, if you don't have 20% invested, then you've got a drag of 2%. And so that's a huge drag. That's bigger than the expenses on most funds and things that you'd be invested in. So, in theory, 20% is way too much. But in practice, for a lot of individual investors, depending on what they're doing, picking stocks, it is better to go slower especially if you have a big inflow of a lot of money at once. Let's say you're starting an account that you haven't invested in anything before. I would not go, let's say you have $200,000 to invest. I would not go and say, let me try to get all that invested in the next 6 months. But let's say 3 or 4 years down the road, can you then be investing 100%? Yeah, you probably could, because, this year's savings can go into one new idea. It's hard to have a lot of new ideas at the same time, or even to have a lot of ideas that are good at the same time and be able to evaluate them all. So I think it's good to be fully invested. I mean, that there's a significant positive return in most years to the market, especially to just owning good businesses on average. So if you pick the right businesses, it's better to be in them than not. So if you have the ability to pick good businesses, then even if the prices are a little high, it's probably going to work out better than cash in the long run. But the one caveat that I would say with that is, do not rush to buy a couple things at the same time. Give yourself some time to make each purchase separately, make the final valuation of each one. And so, if you ever have a situation where you've just come into some money or whatever, and you're like, I want to own 10 stocks. 10 stocks might be fine, but don't try to buy 10 stocks in a year. Allow yourself to have, even though it sounds absurd, a 50% cash position in the first year if that's what you need, to make sure you aren't buying any really bad businesses, things you don't know anything about, and just because you have to get down to your 10th best idea. So I just say, take it slow, but aiming for being 100% invested isn't a bad idea for people. And especially if you're in liquid stuff, you can do that. If you're in illiquid stuff, it doesn't work that way.
Last question. What do you think about using the Kelly criterion for portfolio construction and optimization? How would you utilize it?
So, I don't use the Kelly criterion the way that they talk about it. And I don't think I kind of agree with how most people have talked about it. However, I think that if you break down the Kelly criterion and the ideas of what it's talking about, the Kelly formula that we're talking about, I think it's really useful. The sense that, one, obviously, if you don't have an edge, you shouldn't be investing in anything. And you can see that in the math of what they're talking about there. 2, it's going to depend on what your loss, potential loss that you're going to have in it is. So obviously, and this is where we get to the Buffett side of things, Buffett tries mostly to invest in things, in equities for the long term, in which he sees very little to no chance of a loss. That's going to have a big effect that I see ignored often in the Kelly criterion stuff, where they're talking about it as if there's this is an advantage over something else because it offers slightly higher returns, maybe, but the question is, what is a winning bet of it versus a losing bet? The example that they use, like a horse race or something, well, you'll lose all your money on the horse race. A stock doesn't work like that. So that's a very significant part of it. And that explains a lot of diversification, is that, an index is going to be more attractive than a stock that's equally priced with the index, because the stock could go to zero. The index will never go to zero. Putting that stuff aside, the main thing is, the bigger your edge in something, the bigger your bet should be. The smaller your edge, the smaller the bet. And I agree completely with that part of it. So I would say I often get numbers that might be similar to the Kelly criterion that way, in terms of that your bets should be much bigger and much less frequent. I don't think understanding the Kelly criterion or worrying about calculating it is at all important. Many different...
So it's more so like the principles that you take from it.
Yeah. I think that if you look at the size that Buffett has given as a percent of Berkshire Hathaway's equity, or as a percent of Berkshire Hathaway's portfolio, which at times is the only thing he can reallocate, he comes much closer to Kelly criterion approach than almost any other investors. So you have to ask yourself why that is. You don't have to say, well, it's because he, in some sense, uses the Kelly criterion or something, but you have to ask, why is that? Why is one of the world's most successful investors come much closer to doing what the Kelly criterion should say, was 99.9% of investors never do that? It can be luck, because if he's making very big bets that way, then that would make it more likely that he'd have, very big winners, what winners he'd have over time would contribute such a big amount to his results that it's just like taking really big risk that way. But the other possibility is that he kind of is following that approach. I think it's the biggest difference between Buffett and Graham and Buffett and most people who follow Buffett is his position sizing. even as an individual investor, if you look about the snowball or anything else that talks about it, what he seems to have put in, whether it's arbitrage type situations he got involved with, or things like Geico or whatever with his own money, whether it was nets, he never was sizing those positions at anything near what books and things about them tell you should. He never used the kind of sizing that a mutual fund would use.
It was always buy as much as you possibly can.
Yeah, and buy very uneven amounts. So the net he liked best got a much bigger sizing than something else. And as he followed a situation and liked it better, he was willing to buy more of it. And you'd be surprised sometimes he bought more stocks at much higher prices, actually, than when he originally was buying into them, and seems to have bought them for a period of years. But still, if he thought the situation was more favorable, he was willing to go really big in terms of the sizing of it. Sometimes that might have been a catalyst, something else, but definitely his favorite of a category of stock he was willing to go really big into. He put most of his net worth into Geico as an individual. He didn't say, oh, based on what I studied about Geico, I like the insurance industry pretty well now too, so maybe I'll put, most of it in Geico, but the rest in other insurance companies or something. He doesn't do that. And he's only done that really for the most part when just ideas have been, you could buy anything and make money. Like a market bottom, he sometimes has done that kind of thing just to put money to work. And then he's also done it as he's gotten so big that it's just not possible. So with airlines and railroads, things like that, he did it. But otherwise, he really focuses on much bigger sizing. And I think that makes a lot of sense. And I think that position sizing is one of the most important things you're going to have as an investor. But I think the Kelly criterion and what Buffett did tells you nothing about how you're going to react to those position sizes for you personally. And so for your psychology, it may not work. For Munger psychology, for Buffett psychology, for Claude Shannon's psychology, apparently, that kind of thing makes a lot of sense. And they didn't have any problem with those sorts of sizing. It's certainly theoretically correct. I mean, the idea of applying that idea from a totally different field into how do you compound your money at the highest possible rate over time. Theoretically it's right. The question is whether temperamentally it works for you. Mm-hmm. Yeah. But if someone tells you there's some other way to do it that will work out better, no, it's wrong. The Kelly formula will work better. Other ways can just give you better risk-adjusted returns, you could say, depending on how you measure risk. But it's not true that any other program of diversification that you could have or whatever is ever going to give you better returns than basically betting your edge. Yeah.
Got it. Cool. Well, I want to thank everybody so much for asking the questions. Be on the lookout for future Q&As by following me at Twitter, on Twitter at Focused Compound. I want to thank everybody so much for tuning with us. Sign up at quickfs.net and tell them that you came from Focused Compounding. Help support everything that we do here on the podcast. I want to thank everybody so much for the support. Hit that subscribe button, give us a thumbs up, and we will see you in the next podcast.